Hello, everyone, and welcome once again to the Minicucci Minute. As many of you know, I've been a financial planner and investment advisor with Richardson Wealth for over 6 years, but I've been in this business for 24 years. The reason I'm telling you this is because of what's been going on in the world lately. As they say in that insurance commercial on TV, we've seen a thing or two. Over the past week or so, we've seen that the Russia-Ukraine crisis has taken a turn for the worse, with Russia launching a series of attacks on various targets across the Ukraine. Our first reaction on this news and with what's happening is seeing an ongoing human tragedy. And of course, our deepest sympathies are with all the victims of this conflict. This has created a lot of uncertainty in the markets and has pushed the major broad equity markets lower, which I guess is to be expected. In the short run, the escalation of the situation is very difficult to predict. However, history shows us that despite near-term volatility, these types of events are not generally detriment to the longer-term equity market performance. Usually, when we have global events like this, the markets have a tough time picking a direction. Certain sectors like oil and wheat have gone higher. Believe it or not, Russia and the Ukraine together account for 25% of the global wheat exports. Let's not even talk about the price of fuel. And of course, we still have a few interest rate increases to combat this unprecedented inflation. But let me reassure you that this situation will not last forever. Let's look at this example. This chart shows us the markets how they have reacted to military and geopolitical events since the 1940 invasion of France by Germany, all the way to the Russian invasion of the Crimea in 2014. In certain cases, the market recovery has generally been modest, with the greatest drawdowns occurring when the event coincides with an economic recession. Time will tell whether this is the start of a broader conflict, but our belief is that the economy is not currently in danger of a recession. This geopolitical conflict would likely result in the global economy recovering a little slower than we had originally thought, which would likely keep the Fed in check and allow the market to rally in the second half of the year with a focus on quality growth leading the way. In the coming weeks, we are likely to see large fluctuations continue in both directions as the markets assimilate the impact of the military campaign on the global economy, which still remains difficult to quantify. Yet, history suggests that investors should let the fog of war dissipate, as the months following geopolitical events of this nature often result in gains. Geographically, this backdrop is likely to benefit Canadian and US equities, which are less exposed to Russia. So, again, all this to say, the situation could conjure a lot of doubt with investors and a lot of doubt in the markets. I say, when in doubt, the best course of action is to do nothing. There's no reason to come up with any doomsday predictions and try and time ourselves out of the market. Let the situation take its course, and you will see that doing nothing is actually doing something. Feel free to call or email me if you have any questions or concerns. Thanks for watching.